The buy term invest the difference crowd has been saying permanent life insurance is dying for decades. But this recent report from LIMRA, Life Insurance Marketing and Research Association, proves them wrong by highlighting the 4-year record run that life insurance has been on, as well as mutual carriers paying record dividends. Let's dive in, Dom. And this obviously is going to be a fun episode for us to jam. We're going to look at some of the studies on what's been up: whole life, term, variable life, index universal life. There's actually been one group that has dropped, and that's fixed universal life. So we'll take a look at that. We'll also cover some of the record dividend numbers, which are bonkers to just talk about. And then we're going to go through some Q&A. We got some good frequently asked questions that we're going to land the plane with today. So before we get into that, how you doing, Dom?
I'm doing great. Thank you for asking, Caleb. And I'm beyond blessed to be able to sit here and talk about whole life insurance. It doesn't get much better than that.
Well, we're talking about all kinds of insurance. We're not going to show favorites today.
We're not going to discriminate.
Your favorite insurances, because even term insurance has been up, and it's really cool to see. I wonder, just before we get into that, why do you think life insurance is up? I mean, obviously, with the time frame, it seems like there was a lot of weird things, after COVID or during COVID. But 4 years, record growth. Why do you think that is? And it's not just record growth in term insurance; it's record growth across the board. Why do you think there's record growth there?
Yeah, it's a great question. And if you actually look at the data, one of the things that it's alluding to is that one of the main drivers specifically is the final expense column. And the final expense is primarily, if not only, driven through whole life insurance. And I think there's a couple of reasons for that. One, I think COVID did play a huge part in that, especially if you look at the time frame. And the reason being is final expense in a lot of ways used to be sold where you literally had to cold call somebody through a mailer. And then you would literally set an appointment and then go to the person's house. And you would sit down at the person's kitchen table and you would sell them, and then you have that process. Now, what you're literally able to do, and these companies have created systems for it as well after COVID, is that literally after you cold call, you set it up, you now do everything virtually, digitally. So you're able to sell more, get to more people, have more conversations, and be able to just communicate with more people than you ever have before in today's world. And so I think with technology, I think with the marketing, I think with the systems, I think with what happened with COVID, I think with everything, put that into one big bucket, there just has been a mass awareness on life insurance being sold. And also, final expense is a very lucrative industry to get into. And so when people talk about it and share with their friends, because usually final expense industries and companies, they're more of like a multi-level marketing type of style, model. It's easy to recruit in that space. One, because you have a direct way to get business. It's like, hey, you have this list. You just call these people, right? Even in other MLMs, whether it's like WFG, PHP, et cetera, like you may know the product really well, which it's a little bit more complicated, but it's still hard to find people. They don't really have like a real pathway for you to find people. So it becomes difficult, at least with these final expenses. Like, hey, like you just pay for some leads, you grind your way through, and it's a little bit stickier for sure. And so we have a lot of conversations with people in the space that call us like, hey, like, I'm in final expense. I'm doing that right now. But like at the end of the day, like I want to do what you guys are doing. Like, how do I get there? Right. And so I would think that is probably a big driver when you just start to look at the data.
Yeah. When I first got into the business, I was thinking about starting a final expense business because I just found it interesting. You could do it online, do like a call center. One of my mentors ran a call center. So I just, it's one of those, like when you see something, you kind of like just focus on that or hyper focus. But then after interviewing some funeral homes, I realized that, unfortunately, final expense is one of those products that sometimes doesn't even pay out. There's confusion because they're such small policies. A lot of times they're sold door to door, and I won't call it a scam because that's an overused word, but it's unfortunate that it doesn't, people get it, and a lot of times it does not follow through, and it's like so small in some cases that it's just, it's just the whole thing is a tough space. And so if you sell it and do it the right way, hats off to you. But it's also just a tough space to be in. So just acknowledging that. I mean, can you imagine like door to door? Who's had a positive recent door to door experience? Like it's just not. And the other day, Dom, someone came to me and knocking on my door, and we made eye contact. So I'm like, I can't just not, open the door here. So I open it, and it's this kid who is doing his job, and he's like trying to upsell, or not upsell, like save us money on a garbage. We're going to save like $12 a quarter. And I'm like, dude, thank you, number one, that's great. And I'm like, I don't know if I have the mental capacity to go through all the hoops, call the company to save
To save $4 a month.
I was like, so it was just one of those. But
yeah.
if for those of you that like those good door-to-door salespeople, like it's almost like you just want to pay them just to shut them up. Like, okay, if I pay you, can you leave? And so I imagine some people, like you get this bamboozled, and you're like, okay, I'll pay, what is it, $20 a month or $20 a quarter or something. And unfortunately, either they lapse. There's a lot of quote unquote issues with them. But all that to say, anything sold door to door, I want to hear in the comments if you've had like a really good experience or your horror stories and the experiences. But this is what the article has to say. It says whole life new annualized premium. So this is new annualized premium plus excess total of 1.6 billion in the first quarter. That's huge, dude. That's up 9% from prior year's result. The number of whole life policies sold increased 13% in the first quarter compared with the results from the first quarter of 2025. Life insurance remains the dominant product in the U.S. market, representing 36% of total new annualized premium plus the excess sold in first quarter. So anything that you want to add to that?
Not to that specifically. It's just interesting as we continue to keep going through this, because you start to look at the index universal life bucket, and it's actually very similar in regards to new annualized premium. The whole life, you just say it was like 1.6 or something like that.
Yeah.
The IUL is 1.1 billion. And so you can see that they're still relatively pretty close to each other. And it's again, probably like when you think about like how they're sold in a lot of ways and like the business models that the insurance companies currently have, it's not like you're like, hey, these infinite banking, probably IUL or whole life policies or whatever these scenarios are, is like, it'd be interesting to look at like designs and see like how they were actually, promoted from growth perspective, which I don't know if that's possible, but it would be super fascinating if you could.
Yep.
But then you start to look at, we talked about, you have like the symmetries of the world, First Family Life, like those are all the final expense whole life companies that are very MLM focused recruiting model. Like they almost have their own growth model built into the system. Then you go to the next layer of like Index Universal Life, which is like specifically WFG, PHP, et cetera, which then focuses on IUL. And so you're going to naturally just have growth in this space as long as these companies are still alive and humming and growing for one way or another. And I think people are also, with the market and other things like that, and uncertainty, and people are talking about like they want a better way, and that's usually how life insurance is sold in a lot of ways, right? It's like it's a better way than the market, so put your money into the market, into an IUL or into life insurance. And just the natural conversations that are being had, I think, on social media and the models of these companies, I think are accelerating growth in a lot of ways. And then if you have anything else you want to say, go ahead before I
I just want to correct myself. I shared some things that could have been 2 percentages, 9% of premium increase, and then 13% of policy increase. So there's a difference between number, i.e. a good example is a burial policy. The premium is going to be a lot smaller than a bigger policy. So not all policies are created equal, but I just wanted to be clear that if you're hearing 2 percentages per like quarter, it wasn't contradictory. It was just different types of things that they're measuring.
And then if you keep going another layer, we talked about whole life a little bit. We've talked about index universal life a little bit. The next one would be variable universal life. And you start to like think about, okay, that is up 729 million in the first quarter, which is a significant amount. It's not the same amount as, like the growth isn't the same necessarily as like IUL or whole life. But with that being said, the people that are selling VUL specifically, they are people that have licenses. They are people that have security licenses. These are the typical financial advisors. And so now you break it up into 3 buckets where you have the people who are doing final expense, the people that are in the multi-level PHP, et cetera. And then you have the financial advisors that are pushing and promoting VUL. Not necessarily that any one of those 3 are bad. It's just the buckets of people that are having the conversations. The VUL product I would say over the last 10 years has gotten drastically better, like tremendously better from it's like day and night on how these insurance carriers have now shaped with their guarantees and the way that they work. Once upon a time, they would lapse all the time because they didn't have certain structures
Right.
built into it that prevented it. But because they're now very intensive from a death benefit focused play, with being in a wrapper for the tax benefits that can come with life insurance, it becomes a very incredible product for upside growth at the same exact time that
Yeah.
I know a lot of people that are in the financial advising space that are like rave about VUL. And if they're going to sell any type of life insurance period, that's what they're selling. They're selling it
Yeah.
because they make more, but two, but they're licensed and they think that's superior. For better or
Yeah.
for worse, that's just what it is.
Yeah, and just for those that are tracking that like numbers, variable universal life's new annualized premium plus excess increased 12% in the first quarter to 729 million. So there's a lot of premium going in first quarter. And then the majority of variable universal life carriers report gains, with nearly half reporting double digit growth, which again, I recall that, you know, there have been times where VUL has been lower because it's very much market driven. Like if you feel like confident versus not confident, but policy count, this just goes to show, rose by 4% compared to the first quarter of 2025. So that's cool. And then VUL premium held 16% of total U.S. market. So obviously they're smaller, but all of those things are increasing. So everything that you mentioned is true. And I think that it's going to be more roller coaster like than all the other ones. So we might have times where it's up, and we might have times when it's down. And I think it probably will follow people's confidence in the stock market. And that would just be interesting to look at. Anything you want to mention? I do want to go back to Index Universal Life and share some of the stats, but anything else you want to mention there?
No, go ahead.
Universal Life, so the first quarter 2026, Index Universal Life's new annualized premium plus excess was 1.1 billion. That's 14% higher than results from prior year. So they're bringing in lots. And then the policy count increase was 8%, which was lower than whole life, but 8% year over year. And 6 of the top 10 IUL carriers reported double-digit growth. IUL represents 25% of the total new annualized premium plus. So 25% versus 16%. And, you know, it seems like both companies are getting double-digit growth when it comes to the number of, you know, policies that they're bringing in the business. So it seems like all is up. If we compare Index Universal Life to whole life, it seemed like the percent increase was a little bit higher when it comes to premiums. The policies increase is in favor of whole life, and it seems like whole life still is representing 36% of new business, whereas IUL is representing 25% of new business. So even though Index Universal Life is up a little bit on the increase, it still seems to me with this reporting that whole life is still more people have premiums going towards whole life than IUL in the first quarter.
In let's just say 10 years from now, who do you think will be leading?
I think all trends are saying that Index Universal Life is continuing to pick up steam, and they'll continue to get better and more competitive. So I would imagine, and just looking at how whole life is distributed and sold, it doesn't give me crazy confidence to say that they're going to go like a rocket ship. So I will see, but I wouldn't be surprised if IUL continues to increase. That's by all means not an endorsement of anything. It just, as I'm seeing who's selling, how things are marketed, with technology, I think I think sometimes it's easy to demonize something that you don't understand. And I do think the universal life chassis creates some flexibility, and there can be some innovation. So there's a good chance that there might be a superior product, I say superior with quotation marks, that could come out, and my money would probably be on an Index Universal Life carrier to set that up. Now the next question is, 30 years from now, are they going to keep their promises? I think whole life is way more positioned for that. And I think index universal life, the message might be a little weaker depending on what company. But I think time will tell. So that's I think all studies are pointing that index universal life is increasing faster than whole life.
Yeah. I know we did a video similar to this not too long ago, maybe a year ago or so. It'd be interesting to go back to see what those numbers were and to see the differences in regards to like the percentages then, the percentages now, and just like almost keep track of the trend and see is the gap tightening every single time, because it feels like the gap is tightening between whole life and IUL every time we just have this discussion from top of the head without actually validating that data. So I would likely agree with you just because of the way that it's being sold, period, for better, for worse.
Okay, so term insurance has also, the new annualized premium rose by 9% to 788 million in first quarter. Well, that's crazy. Let's go back to the variable universal life. That's a permanent product, but there's more people paying term premiums first year than variable universal life. So that's cool. Policy count grew 5% year over year. Growth likely reflects continued digital platforms. That's pretty clear. Underwriting is making it easier, improve agent productivity. And like you go on YouTube, you listen to shows, every talk host has got some sponsor, whether it's Ethos or Policy Genius or whatever, they're always, selling it. Now, also what can be challenging is we look at lapse ratios, and a lot of times the lapse ratios get reflected in all these policies, and anyone that you talk to will say most of that has to do with term insurance, and not all of that is bad. Like your policy could end, and that technically could be a lapse. It could be canceled prematurely. That could be considered a lapse. And so, you can see there's a ton of policies coming in, 788 million. What's the biggest pitch to term insurance? It's super cheap. So it's likely that even though the premium only represents 18% share of the insurance market, the amount of policies that are being sold are insane, and we know that lapse ratios have everything to do with policies, not premium. And so that's just something that I think needs to be talked about. That's another example of how percentages could be a little bit misleading. We'll use percentages like, this many people cancel or no longer have coverage or cancel their coverage. But it's a big portion of that is coming from term policies. And what's the pitch? It's super cheap. So it would be interesting to dive in. And I don't actually think there's real data, because it's every company's a little bit careful with what they share. And so that's why things have been a little bit foggy. I don't know if you have any comments there.
No. And I would just say that this will likely continually be a driving force. Like, I can't imagine a world where it's not, just due to the sheer fact of the things that you mentioned. But also there's companies like State Farm, for instance, that are just massive behemoth of companies that's really all they sell, right? They're like, you get the State Farms, Allstates, they're just selling term insurance for majority of it, because they're not like life insurance agents or advisors. They sell home and auto, and then they give their clients discounts for getting term insurance. And so that's a constant theme of like, I'm going to try to push term insurance in general just to get you the discount, but also get me paid. And it's a good thing in general. Like, more people getting insured, that's never going to be a bad thing. And then you consistently have more of these companies that are demutualizing, and one of the largest term insurance providers right now is Prudential. And you start to look at like the history of them. Like, they used to be a massive whole life insurance carrier, and they used to do a lot of really great things in that space. But the thing that probably is going to be more profitable in a lot of ways is pushing term insurance. And so because of that, these companies will keep pushing it regardless of the end of time. And not if it's like a bad thing, it is.
Term is great. And my hope, if I could snap my fingers and do anything, it would be that these increase a lot more, because there's a lot of families, a lot of people that have no business doing anything permanent insurance, but don't have any insurance maybe other than a small group plan. And it would be incredible if you could snap your fingers and get the policy count to grow by 20-30%. I mean, that would be awesome. And so, we'll hopefully that will continue to grow. It is, it is interesting that with all the marketing messages about permanent life insurance is a scam, all these things, and all these people pushing buy term, buy term, buy term, that it's only 18% of the US market. And technically, the policy count grew by only 5%. 5% is great. And again, we have to recall that's maybe a lot more policies that are being pushed. It's just interesting.
Yeah,
And
my thoughts around that is people don't like to buy the thing that they quote unquote should get that's
yeah,
not going to benefit them today, and so people aren't going to take action of like, well, I'm not going to die, or like it's not going to benefit me. So the action in the moment is not as enticing, even though they know they should because it protects their family,
yep,
versus if you get like permanent products, the people that actually like learn about it or educate about it, they're like, well, this is something that I could utilize today to like build wealth, get more for myself. And so I think the natural psychology around it, not saying that permanent is better, but I think that people will likely take more action on something like that because in their mind moves the needle forth more in their financial portfolio
yep.
than term insurance, even though buy term invest the difference is a great strategy for a lot of people.
All right, not all life insurance has been up here, Dom. So fixed universal life, they have not been compounding their premium in numbers. The numbers look like they are at 221 million. They're down 6% year over year. But the number of policies sold, however, have improved 5% from the first quarter of 2025 till now. And so as of, I believe, 4 of 10 fixed universal life carriers reported double-digit policy sales growth. And obviously, you could do the math that others did not. And so I don't know what you make of that. It only represents 5% of market share. And there's probably some good reasons. I'm curious your take on that before I give my take.
Yeah, I think that fixed universal life, so just UL without the IUL into it, is kind of the ugly stepchild in the life insurance industry. The reason being is it's a lot more expensive than term insurance, and it doesn't really provide any cash value. And so you get this kind of in the middle awkwardness where it's like it is the cheapest relative for the most amount of death benefit you can get. So it's like, okay, great. And so it is superior from a permanent perspective if you're comparing it to like whole life, IUL, etc. But then you don't get any of the like the bells and whistles, the sexy cash value to be able to utilize. And so when you're trying to sell to somebody and you're like, hey, like this is something that's a lot more expensive than term, right? Just so you know, but you don't get any cash value, but you get this permanent product. Well, again, it's kind of what I said against psychology. It's like, so I'm just saying that I'm going to pay all this money into this thing that's will pay out, but I don't get to utilize any of this cash or cash value today. But and I think people are also severely uneducated as well from an advisor perspective, because of all of the companies that the models that we've talked about, whether it's been Symmetry, Final Expense, like all these other things, like they don't really have these types of conversations with UL. Like it's just the swept under the rug product that nobody really talks about for the most part.
Yep. Yeah. Couple things. It's way less popular than term insurance, but 221 million is not nothing. But you're totally right. From a product standpoint, there's PPLI that people are using instead. There's variable universal life that people are using instead. There's an argument to be said that whole life could give you similar death benefit potential numbers, but give you maybe a lot more flexibility, even though the premium is quote unquote higher. People like the idea of, I'm paying and I technically have cash value that I can use. So while guarantee universal life or fixed universal life could play a role, you're totally right. It just fits. It's like that. It's that stepchild that doesn't really, have a friend. All the siblings are playing and it kind of is left out. So that's that. Glad we mentioned that. Would be curious to hear people's thoughts. But the dividends have been sky high, man. 2026 is shaping up for the biggest dividends yet, and obviously we're only going to share some. But like Northwestern Mutual is reporting $9.2 billion. It's a massive, dude. That's a record. It's up $1 billion from 2025, and they've been paying dividends for 155 years. It's kind of, we get desensitized a little bit to that. I mean, that the track record and just the size. MassMutual is paying a record dividend of $2.9 billion. New York Life is paying a record dividend. Get this, 172 years in the counting of 2.78 billion. And then the Guardian is paying a $1.7 billion dividend. And yeah, it's pretty wild. It's pretty
Yeah,
massive.
but I would like to talk about why is this? Like let's just I don't want to sugarcoat and say like this is the greatest thing since sliced bread just because. I would like to hear from you and like why do you think this actually is? So that there's like some context behind it versus just like, hey, these are some massive numbers.
Well, I mean, they got if we had, and maybe we can search if this is public, if we had how many assets they hold. It's just a numbers game. All insurance companies play very much the same deal, and so that's just all that tells you is all these companies are bringing in more business than they're paying out, and as long as they do that, all companies, big or small, are going to be paying record dividends. So it just comes down to those numbers might feel big, but I mean, I could do this unless you beat me to it. Like if you just look at how much does Northwestern Mutual manage, I would imagine it's very large. Do you want me to look that up?
No, I mean you can if you want, but I just wanted to just overemphasize like that is the point behind this. Like if you look at history, dividend rates as a whole are very low. Right. So I want to make sure that we're being very specific around what we're discussing and talking about. This isn't talking about dividend rates increasing or, anything like that. What this is essentially saying, if you look, these insurance companies have been around for 170 plus years. Right. And so their balance sheet continues to compound. And all these numbers that we looked at before of whole life insurance increasing, universal life increase. Universal life technically is for some carriers, a product that's on the balance sheet or it's like, expense, et cetera. Like there's things that factor within that. But when it comes to like specifically these dividends companies like MassMutual, Northwestern Mutual, Guardian, even Penn Mutual, right? They do whole life and IUL. They just are so big and have been around for so long that they're, like you said, they're selling so many products that they're having to pay more dividends out to more people because they've been around for so long. And that's really what it's saying at the end of the day. And just by natural attrition of being in business for a long time, you're just going to grow as a company.
That's why when people say percentages and all, someone could say, and to be honest, if they didn't grow, you could use that logic to say, well, if they paid out a 12% dividend here and now they're only paying out a 6%, well, that's a decrease. Yes, but they're also growing year over year. And so it goes back to rate versus volume. And that's a perfect example. So we'll see. It's now on the third attempt. AI might not be pulling through for us, but I'm sure though you can look in the comments. Somebody in the comments will let us know how big these are. And I think what we'll find is they're way bigger than the dividend that they're paying out for right reasons. If you're a high-earning professional, entrepreneur, or someone who wants more control of your money, we offer something called a clarity call. It's a one-on-one conversation where we learn more about your situation and walk you through how integrating whole life insurance could help better your financial situation. It's no pressure or fluff, just real clarity on whether this strategy is right for you. Click the link in the description or tag comment below, and we'll walk you through exactly how we can help you. Yeah. Okay, let's go to Q&A.
Love it.
And we got some good questions. We got a super long question. I swear sometimes that people are trying to break a record for how can I write the longest question possible, and this looks like a lot of questions. So I'm gonna read this for the first time. We can talk through it. This is someone that commented from the episode that I just got released from Tom Love, and he said, I guess I don't know if it's a he or she, but I am someone who's trying to learn a little bit about how life insurance can be utilized in retirement. But after hearing him talk, I'm no closer. I have so many questions. Question number 1, how much are premiums? Number 2, do you have to pay lump sum? Number 3, does it act like an annuity? Next question is how do you get the money to pay for this product? What is it taxed? What's the difference between paying premiums and paying tax? In addition to premiums, how much or you paying in interest on these loans? Next question, I get the idea of safety in retirement, but he seemed to harp on not paying taxes, but ignored all the costs of insurance. And then last sentence, with all the legislation catering to retirees tax is really mitigating already. I don't get that. With all the legislation catering to retirees tax is really mitigated already. That'd be interesting to hear what your thoughts are, because there's no such thing as a retiree tax, but maybe there's, step up in basis concept, or he's talking about brokerage accounts, or maybe Roth IRAs, or I would have to get clarity on what that last point made. Here's what I would say to that whole thing is we're not going to answer question by question. We're just going to say that you are totally right that life insurance, you need to factor in all things, and you need to, when I'm thinking about looking at this as a retirement asset, you just look at what are you currently doing and what is that going to result in? And then you simply ask, is adding life insurance as a portion to what I'm doing, like integrated, going to give me a better result? And you include costs of insurance, the commission, all that stuff is included in illustration. Like, you'll be able to see that up front. And you look at the different strategies. So you ask how it's paid. It could either be paid from cash flow, or it could be paid from a portion of assets. There may be a need or less need for the death benefit. There may be a desire for the chronic and critical illness rider. There may be less. All that goes into a strategy. And I will say that I like Tom, and it was interesting to sit down with him, but I do not recommend, and I've said that very publicly, to put all your money into insurance. I think whether taxes go higher or lower, I don't think insurance is going to be the savior that saves everybody. So while I think it can be a powerful asset for some of the reasons that he posted, I'm not endorsing that everyone put all their money in insurance. Yeah, we've been pretty clear about that. So I just want to point that out. And I think the best thing would be for you to connect with someone on our team or somebody that you trust, share your scenario, and see for yourself, does integrating insurance into your scenario make your situation better? All those questions, by the way, are important and they can get answered, but all of them can get answered in the context of, is this going to help you better or worse? Dom, anything that you want to add to this?
No, I think you said that well.
Okay. Let's why don't you cover the next question?
Cool. Let's do it. So the next question is from an episode that we did with Jason Lowe on family banking, and Dub Digital. He said, but the life insurance policy is a fixed amount. Over time, doesn't your ability to exercise the policy's purchasing power via a loan decline when compared to the real rate of inflation? So I think this is a conversation that people always like to bring up, in saying that by putting money into life insurance specifically, and it's actually funny because it goes both ways. You hear people that are big into infinite banking, or that are like selling life insurance, to say like, you want to put your money into life insurance so that you can outbeat inflation. I've heard many different reasonings how that's true. And then you hear often it's like, well, life insurance gets such a low rate of return. The growth rate on it is very insignificant relative to the rate of what inflation actually is. And first and foremost, I would say that regardless of where you put your money in, regardless of where the asset is, you're going to be competing with inflation regardless. And so you're really not comparing like, is it beating inflation, but you're really competing against like where you actually store your capital. And so if you're looking at the storage of capital to increase purchasing power, you have to just ask yourself, is it better to put it into a fixed bucket that is somewhere else, like a savings account or a money market, or something that is higher risk, like in equities, etc., or is life insurance the right asset for you? And I think it doesn't come down to, is it going to beat inflation or not? It's going to come down to the utility and characteristics around life insurance that can then help give you extra benefits to everything else that you're trying to work towards. Because and especially for inflation, you have to ask yourself, like, what year are we looking at inflation? Are we looking at inflation this year to 20 years ago? Are we looking at the average? Like, inflation is just It's been so different. I mean, if you look it up, it's like average inflation is 2.5%. Well, if average inflation is 2.5% over a 20-year window, well, then in theory, over a 20-year window, if you design a policy right with the right company, you can see probably closer to 4.5% with the life insurance policy. So technically, your purchasing power has gone up with the ability, if you're putting it there versus somewhere else, like a bank account that when the rates were lower, it was getting, less than 1%. And so everything is in a box, can sound good, but when you start to look back and you try to look at everything holistically, it becomes a deeper conversation at the end of the day.
Well said. Well said. I do have an update on Northwestern Mutual, by the way. So this is coming from ChatGPT, but it is referencing Northwestern's website. So I take this for what it's worth. Total surplus, which is just essentially a form of profit, 42 billion. And the general account assets, more than 335 billion. And then life insurance in force, this is the death benefit coverage, is 2.5 trillion. So we're dealing with some big numbers. And so just thought I would close the loop there. We'll see how many people will stay at the very end to get that. We do have any other thoughts before I answer the last question?
Nope. Let's move on to the last Q&A.
Question is, this came from an episode with Steve Gibbs that I interviewed. Do you recommend putting whole life insurance /IUL in a trust? If yes, revocable or irrevocable, and why? Great question. I just want to be clear that this is not advice, tax advice, or not estate planning advice. So make sure to talk to someone that knows your situation. I would say for most people, you don't want a trust to own the insurance, because you can lose some benefits and flexibility, especially if you're going to play the irrevocable trust game. And so it's way more common to have the death benefit get paid to revocable/irrevocable trust, and revocable trusts become irrevocable upon death. And so that's common, but it's not as common to have life insurance be owned by a trust for most people. Now, where this changes is if you really want to start, if estate tax is becoming an issue, then you have to do some deep planning and have irrevocable trust essentially set up where it can own and potentially have money passed down in that irrevocable trust system. Do not recommend it for most people because it can be complicated and expensive, but that's where, and you would do that to save estate taxes. For most people, I would not recommend having a trust own the life insurance, though you could have your revocable trust have money get paid in if you're very clear about how you want that money paid out. That would be a lot cleaner than having it paid directly to your kids. But life insurance is one of those things that can cleanly pay to your kids if you don't want the hassle when it comes to trust and all. Dom, any final words on that?
Yeah, I would say that people should do their due diligence specifically on a revocable versus irrevocable in a lot of ways. I know we've done in the past a lot of content on like the Rockefeller method, waterfall method, and I think the conceptual concept of how that strategy works is good in theory. But I do think that you can set something up regardless of who you are foundationally like that. But when you're using these tools, specifically the revocable or irrevocable trust, the waterfall method and the Rockefeller method is specifically with a irrevocable trust in a lot of ways. And a lot of that comes down to some of the tax things that you were referring to. But when you have one of those set up, you lose a lot of control in a lot of ways because it's no longer, you, it's a separate entity. The revocable trust standpoint is something that can be revoked, which it's still, you are the one, the same entity as it, but that doesn't come with like other tax benefits or other strategies around it. It just has other benefits where, I think everyone could, to some degree, still get one of those that could help you in your financial journey. But that 5%, maybe even less than 1% of people should have like a truly complex strategy where a irrevocable trust is set up. And the majority of other people, if you have, let's just say $50,000 or more of like net worth, should probably look at a revocable trust strategically, but life insurance shouldn't necessarily be kind of like owned by that still, like you said.
Perfect. All right. Well, we love to hear from you in the comments on all the things that we mentioned. So please let us know your favorite part. If you have a policy that you want us to review, we'd be more than happy to do that. There'll be a link down below if you want to talk to someone on our team to see if life insurance integrated for you would make your situation better. We'd love to have a conversation there. And as always, Dom, thank you for being the co-pilot here and helping us with this episode. It's fun to cover the very exciting topics of life insurance with you. It's like, who would have thought? Who would have thought we'd be doing a show on life insurance? I'm very grateful for it.
Yeah, even talking about the most boring stuff for 42 minutes later, here we are. So
Here we are.
anyways,
I love it.
with that being said, you guys have a great rest of your day, and until next time.